very much, Karishna. It's a pleasure to be here today in Miami at Private Markets Group, Private Wealth in the Latin American and Caribbean region. We're very fortunate to have Michael Leachin sharing his insights with us today. My name is Amy Lawrence. For those of you who don't know me, I'm the founder and wealth advisor of Gorilla Investments. A little bit about Michael before we start. Michael is widely regarded as a visionary entrepreneur whose philosophy of doing well by doing good has resulted in extraordinary business success and inspiring philanthropic initiatives. He's the founder and chairman of Portland Holdings, a privately held investment company that manages private equity and has ownership interests in a collection of diversified businesses operating globally in sectors including financial services, insurance, consumer goods, media, tourism, agriculture, real estate, development, targeted radionuclide therapy, and clean and nuclear energy, which is a mouthful. Michael has received Doctor of Law degrees from a number of distinguished universities in Canada and Jamaica. He's been profiled in Forbes, Fortune, Canadian Business, Black Enterprise, and Time magazines. From 2011 to 2016, Michael held the position of Chancellor of Wilfrid Laurier University. In 2008, he was awarded the Order of Jamaica, one of the country's highest national honors for outstanding service in business and philanthropy. In 2016, he was appointed chair of the Government of Jamaica's Economic Growth Council in an effort to bolster economic development. So with that, we're going to get started, Michael, and I'm going to turn it over to you. Tell us how you got started. You've been in an array of industries. Tell us where it all began.
So, thank you very much, Amy. Good afternoon, ladies and gentlemen. Can you hear me at the back?
Yes.
So, in 1977, I went back to Canada, having spent 2 years in Jamaica, because I was on a scholarship after completing my engineering degree. So I went back to Canada in 1977, in May of 1977, and I applied for a civil engineering job. I sent out 100 resumes, I got 100 rejections. And I had three options. Number one, to be a soap salesman. Number two, to become a long-haul truck driver. And the third was to sell mutual funds. So I opted for the third. So, back in 1976, at 26 years old, I knew no one with money. So I had a cold call. So when someone said, okay, Mike, you can come and see me at my home, I would work all day and then 2 appointments at night. One at 7, one at 9. So just before knocking on the prospect's door, I was saying to myself, but this family here has been so gracious to allow me to come into their home and give them financial advice. Wow. So I felt such a debt of gratitude that I asked myself the question, what is the highest value add I can give to this family here tonight? What's that one thing that if I gave to them, it will transform their life? And that's coming back to me, Mike, make them wealthy. That's the highest value add an advisor can give to his or her prospects, right, Amy? Make them wealthy. Being an engineer / scientist, I thought, is there a formula that if you practice consistently, the only outcome is wealth? Because if there's such a formula, I want to know what that formula is. And I'm going to practice it, live it, advocate for it, and be the role model for it. So my code to break as a young man was to find that formula. As an engineer, there's a protocol that we go through whenever there's a question at hand. Number one, you observe. Number two, you create a hypothesis from your observations. Number three, if the hypothesis, you stress test the hypothesis. If it holds true, you codify it, and then you hardwire it, becomes you. So I observed wealthy people all over the world. We did not Google them. And then I concluded that every wealthy person did people who created wealth did 5 things. Number 1, they owned a few high-quality businesses. Not too many, a few. Number 2, they made sure that those few businesses were domiciled in strong long-term growth industries. Number 3, they made sure that those businesses use other people's money prudently. Number 4, they really understand them. And lastly, their attitude towards ownership. There's no artificial time to sell. They'll hold for as long as those few businesses remain, 2 conditions remain. They remain high quality and the industry within which they're domiciled remains in a strong long-term growth mode. So I concluded that those are 5 laws of how wealth is created by every investor. So, what I did, remember selling mutual funds. So I thought, why do people buy mutual funds? They buy mutual funds to create wealth, right? So let us see whether your general mutual fund would abide by those 5 principles. Okay, your typical mutual fund has how many securities? 100, 150. They diversify, right? So, law number 1, wealth is created by owning a few high-quality businesses. Is 150 in a mutual fund few? Yes or no? Pass or fail? Fail, so the first count. Secondly, wealth is created by really understanding what you own. If you own 150 different securities, is it possible to understand them all? Yes or no? Pass or fail? Fails. Number 3, wealth is created by making sure what you own is domiciled in strong long-term growth industries. If you own 150 different securities in a fund, that's what, are you sure they're all in strong long-term growth industries? Are you sure? No. Pass or fail? Number 4, wealth is created by using other people's money prudently. If you own 150 different stocks in a fund, are you sure you have 150 crackerjack CFOs? Are you sure? Pass or fail? And lastly, the average turnover rate for a typical mutual fund is 80% per year. The inverse of that is the average hold period is 14 months. I don't know one person in the world who buys and sells his or her businesses every 14 months. So I thought, on 5 counts, this generic product that's being sold and people are buying to create wealth has no resemblance to how wealth is created in the real world. So this is really, I use more technical language in my mind, this is really a fraud because there's a mismatch here between why people are buying it and what the funds are actually doing. So I'm going to start a fund that is honest. I'm going to start a fund that really is honest to those 5 principles. And I started a fund that had only 15 securities. Only 15. And I cheated a little bit because 60% of the 15 were in the asset management space. Because the best business model in the world is the asset management business model. The best. So and then the other 40% consisted of Berkshire Hathaway, and this is back in 1977. And securities that Mr. Buffett chose. So that was my fund of 15. I could understand the asset management business because that's the industry I was in. And so I cheated a little bit. So it wasn't a fund as such, it was really an aggregating vehicle to capitalize on the fact that the baby boomers, this was not 1987 when I started the fund, the baby boomers were eventually going to be in a state of massive investing because the typical baby boomer in 1987 would have been 36. And at 36, that's when you realize, oh my gosh, I'm coming up to the age where I'm undersaved. So I better start saving. So the best way to participate in saving for the baby boomers was not to own shares in a bank, because then you could get loan losses, or insurance company, you get underwriting losses, but to own shares in an asset management business. So that industry was just about to go exponential. I started this fund, the AIC Advantage Fund. We started with $800,000 in 1987. By 1999, 15 billion. So what I did, I codified how wealth was created. There's a framework, the 5 laws, and I built a fund that is 100% in keeping with the 5 laws. And that's how we got assets coming in. That's a significant reason. In fact, in 1997, we had $4.2 billion in net sales in Canada. So AIC became the largest privately owned Canadian mutual fund, asset management business.
It's some story. It's an incredible both execution of the principles, but also, Michael, you've really studied the principles of wealth creation. Right from your get-go, selling mutual funds and what you can do to help those families, to the present day, thinking about families and how wealth is passed on. If you can, share with us some of your frameworks, your recipe for success on wealth creation, both for the advisors here themselves and for their clients too.
It's fine. So the first framework would be embodied in the 5 laws of wealth creation, but I refined it a little bit more so with time, because Warren Buffett once, when he was asked, how come you're so successful? He said, I'm a capital allocator. And all of us in this room, we are capital allocators. That's what we do with your family office. You're capital allocators. And being a capital allocator, I'm a better investor. So capital allocator is a parent and it has 2 children. I'm a capital allocator and I'm a better investor because I'm a business person. And I'm a better business person because I'm an investor. So being a capital allocator, we have to think like an investor. And secondly, we have to think like a business person. So I just went through with you 5 laws of wealth creation, which will define how successful investors truly invest. So that's the first component. So let us take a look at the qualities of businesses, of wealth creating businesses. So if we know the framework pertaining to what make a great investor, the 5 laws, and if we know the framework pertaining to wealth creating businesses, you combine both, you don't have to think anymore. Just execute on your framework. So I define 10 qualities that are endemic to successful wealth creating businesses. Number 1, they're invariably owner operated. The owner and the operator invariably is in one. Number 2, the ownership is heavily concentrated. Ownership is heavily concentrated in wealth creating businesses. So owner operated, heavy concentration of ownership. Number 3, there's personal identification between the owner and the business, and the business and the owner. Apple, whose face comes to mind? Who do you think of? Steve Jobs. Steve Jobs, person, which business comes to mind? Apple. So there's personal identification between the owner and the business and the business and the owner. Number 4, the management style would not be defined as democratic. It's autocratic. And at the extreme, dictatorship of wealth creating businesses. Number 5, management style would be defined as entrepreneurial. Number 6, wealth creating businesses that have low turnover of management. Number 7, when capital is allocated, there is a symmetry between the risk and reward. In other words, if it's a good capital allocation, the net worth of the owners increases. If it's a bad capital allocation, the net worth of the owners decrease. Hence, it's the win, tails the lose. So there's symmetrical risk reward for management and the owners. Number 8 characteristic of wealth creating businesses is that they set goals for the long run. The long run, not quarterly. Number 9, the focus of the mind and spirit of the organization, of the board, mind, spirit, is singular. Growth, growth, 10, the validation of success of wealth-creating businesses will be a function of margins, revenue growth, customer satisfaction, efficiency, etc., etc. Now, those 10 characteristics, if you were to superimpose your typical public company against the background of those 10 characteristics, you'd see that your typical public company has the exact opposite of those 10 characteristics. So I'm not saying we shouldn't be buying public companies. What I'm saying is when we buy any business, public or private, we should look for those characteristics.
Great, thank you so much. You talk a lot about predicting. You're always looking at the trends when you were in the mutual fund business, why people invest in mutual funds, the baby boomers. You've been recently looking into new areas, including cancer treatment and nuclear. Can you tell us what your thoughts are around those trends specifically and the successes that you're having in that space?
Okay, so the other framework I'd like to share with you is every successful wealth creator is guided by what we call the 3 Ps. They all predicted something. They took a view of the world or some sector. They predicted. Number 2, they planned for their prediction. And number 3, they persevered with their plan. PPP, predict, plan, persevere. So how is that relevant to what I've said so far and what I'll say as of now? In 1983, I was 32 years old, and I thought I need a methodology that I can, with confidence, predict. And I thought the best methodology is demographics. Demographics. So at 33, I thought, what are 33-year-old? Well, I will be considered probably the median age within the baby boomer cohort. People born between 1946 and 1964. I was born in 1951. So in 1983, and the baby boomers then were the largest percentage of the North American population. So whatever they do, there goes the economy. So in 1983, I was 32. I thought, what are 32-year-old families doing today? Well, they're buying furniture, rugs, car, they're consuming. So we are in this state, a state of massive consumption, because the largest percentage of the North American population is in that mode. But wealth is not created by doing what is being done today. Wealth is created by doing today what will be done in the future. So I thought, okay, 10 years from now, by 1993, what will the baby boomers be doing? Well, 1993, I'll be 42. At 42, what do 42-year-old families think about? Oh my gosh, I've been consuming all this while. I have 23 more years to go to retirement. I don't have enough money saved. So there is a saving and investing boom coming. So how do I participate in that coming saving and investing boom today? As I said, I can buy shares in an insurance company, but I could suffer from underwriting losses, so that's not the bullseye. I could buy shares in a bank, I suffer from loan losses, that too isn't the bullseye. But if I bought shares in an asset management business, that is the bullseye. Because the asset management business model is the best business model in the world, period. Think Lehman Brothers. When Lehman's went bust, the only asset that stood was Newburgh Bourbon, because they have no on-balance sheet assets, right? They have margins are 100% once they clear their fixed expenses. They're infinitely scalable. They have no debts, right? They have no bad debts to collect. So that logic guided me to start investing in asset management businesses early in 1983. Actually, I started. And to give you an example, in Canada, in 1983, the total assets under management of all wealth management companies were $5 billion. Today it's $2 trillion. So that's 400 times from 83 until today. So Demographics is a wonderful predictor that you can have confidence in. So today, I'm 72. So what do 72-year-old people think about? Oh my gosh, I want to live long, and I want to have a great quality of life. So coming, or maybe in the early innings of a healthcare boom, because remember, whatever the baby boomers do, there goes the economy, and today we're even more so because we're the ones with the wealth. So there's coming a healthcare boom. But within, unfortunately, as you age, the more likely you are to get cancer. So there's coming a boom within a boom, oncology. When you think of oncology, what comes to mind? Chemotherapy, brutal. Systemic, it poisons your entire body. Or radiation, it fries your body. And both modalities have been around for 90 years, so they're ripe for disruption. What's going to disrupt? Chemo and radiation. TRT, targeted radionuclide therapy, or another word, PRRT, which is peptide receptor radionuclide therapy. In other words, identifying what we do, we identify protein molecules or peptide molecules that are attracted to the unique receptor on a cancer cell. And once we identify that molecule, so we know we can get to that cancer cell and that cancer cell only, we now attach a isotope by the name of gallium-68 to the peptide molecule, which takes the gallium-68 to the cancer cells, and that now lights up on a PET scan. So we can see exactly where the cancer is in your body. And once we can see it, we can treat it, because seeing it is proof perfect that receptor is there. So we now substitute the gallium-68 and attach another radioisotope, lutetium-177, to the protein molecule, which takes the lutetium Lu-177, that's a periodic table symbol, which the lutetium is taken to the receptor on that particular cancer cell, and lutetium emits beta rays, which are 2 millimeters in length, it zaps the cancer cells and leave neighboring cells alone. So that's how cancer is being treated today, and we see more and more of that treatment. Novartis recently last year got approval for their drug Pluvicto, Pluvicto, which is specific to prostate cancer. That's the modality is PRRT. A couple of years before, they came out with a drug by the name of Lutathera, which treats neuroendocrine type tumors, including neuroendocrine pancreatic cancer. And today, more and more companies are developing different treatments to address a slew of an expanding menu of cancers. So note PRRT, do your research, because that is people who have been end state in prostate cancer. Oh, by the way, 2 weeks ago I was in London, I was in the Cotswolds, because this gentleman, who knows Duran Duran? Anybody? Andy Taylor had phase 3 prostate cancer. Andrew Taylor, right?
I didn't know that.
Yes. So Andrew was on his deathbed, and he got the treatment of lutetium. Today he's doing concerts again. Google Andy Taylor, lutetium-177. So that's a modality that will become more and more prevalent in the world. We got involved with it in 2018. The second prediction, and these are, when you say prediction, one usually say the immediate conclusion would be you can't see around corners, or you don't have a crystal ball, but there are ways to predict that you can have high degree of confidence. For instance, the second year of prediction is the energy mix of today is, okay, most countries, they have an objective to be carbon net zero by 2050, right? And most countries in the world, they don't have an idea as to how to execute on it, or to provision for that aspiration that they have signed up for at the Paris Accord. Because to get to carbon net zero by 2050, we will need a lot more nuclear energy. Why? Because the energy mix of every single country in the world today would be defined by the hub and spoke model. At the hub, you have fossil fuels, and the spokes will be renewable energy. There's some wonderful qualities that fossil fuels have. Number one, they're always on. Number two, they're highly scalable. Number three, high energy dense. Or one, bad quality, dirty. So what we need to do if we're going to get to carbon net zero by 2050, we need to remove the fossil fuels at the hub and supplant it, replace it with some other modality with similar qualities, always on, high energy dense, and scalable, but but clean. And the only source is nuclear. Only. But nuclear won't come in the form of those big gigawatt plants that you would conceive of. They now come in the form of small modular reactors that are built in factories, or micro modular reactors built in factories again. So there's a truism that goes like this. Whenever there's a shift in the dominant source of energy, there's also a shift in economic power. So ladies and gentlemen, I'm suggesting to you that there's a shift happening right now in the dominant source of energy from fossil fuels to nuclear. So there will be a commensurate shift in economic power. The question is, what are you going to do about it?
Thank you, Michael. Shall we take a few questions?
Please.
Okay, I'm going to take a few. If you have topics you'd like Michael to address, please raise your hand. I'll take a few. Alrighty. Or we can talk about philanthropy. One of your.
I'm so sorry.
Think about your.
We have time for one question.
Okay.
Unfortunately, 30 minutes flies by. Who's asking a question?
Good afternoon. My name is Felipe Ballestas, and I really like your approach about the strategy when you started the firm with the Warren Buffett holdings and the companies that he buys on. But when you start a fund, one thing is to start to have the strategy, which yours was great. And the other thing is, how did you get your clients?
So the question is, how did you source your clients?
How did I get clients? Well, very good question. Because to build a successful business, three qualities have to be present. Number one, the business has to be differentiated. Absolutely. Number two, the business has to have a great reputation. If you could think about long-term sustainability. Number three, the business really and truly has to address clients' needs. So when I went out, I started off with a fund. I bought a fund with $800,000 in assets under management. So I would now go and sell the fund myself. And so when people saw I only had 15 securities, they'll say, Mike, this is not a fund. Mutual funds, they have 150 securities. Yours is 15. I said, really, what do you want? You want to buy a fund with 150 securities, or you want to create wealth? If you want to create wealth, this is how wealth is created. These are the 5 laws. This fund is a 100% expression of the 5 laws, which is how wealth is created. And again, I had to persevere. So I had to go through the hockey stick curve before I got exponential.
Thank you so much, and unfortunately that's all we've got time for today. Rogerio Tipe, if you would just mind waving at this table over here. Rogerio can answer any additional questions that you have, as Michael has to run to the airport. But thank you so much, Michael, for your time today. Thank you for joining us in beautiful, sunny Miami. We'd like to have you back. Thank you very much to Markets Group and to Commissioner Perez for having us, and thanks everyone here for participating today.